Silver is about to retest all-time highs. This is a moment patient silver stackers have waited years for. In the past month, silver has surged over $47 per ounce, rising by nearly 20% in 1 month. If this pace continues, then silver will pass its all-time high in less than 30 days, and perhaps even set a new record, above $50 per ounce for the first time in history. If you value the gold and silver stories that no one else tells and want to understand precious metals' place in history in the modern world, this channel is for you. Completely ad-free and a commitment to never overhype. Please subscribe to support our channel. Thank you. Sometimes we get up on a Monday, look at the prices of metals and look at the comments on YouTube, and we're reminded how quickly things can change in this industry. Each of these videos takes about a week to produce, from research, script writing, to recording the audio, producing the video. It's no surprise then that some of our videos where we talk about price can be a little outdated by the time they're published. And last week's video is a case in point. Between the time we wrote the script and published a video, gold had moved up over $100 and silver had gained over $3 per ounce, crossing 45 and threatening a march on 50. As we record this, silver has surged 2% overnight and is comfortably over $47. And remember that, we're going to come back to it, it'll be important later. If we have a repeat week, then by the time this video comes out, it's possible that silver will have crossed $50. These are some important numbers that we're coming across, and there will be pressure on the way up. With silver growing quickly, there's an understandable tension in the air. And history tells us we should be wary of certain price levels. But there's also a first time for everything, and the forces that pushed silver down before breaking 50 in the past are unlikely to stop it this time. The last 2 times silver has approached $50 was once in 2011 and in 1980. The all-time high was set in 1980 at $49.45 per ounce. If you look at pricing data, you might get some conflicting numbers. Silver spot is the physical price of silver, while silver futures is a derivative contract used to hedge and speculate on silver. The price of silver futures in 1980 reached a high of $50.35 the same day. We are mainly concerned with spot, which was the $49.45 we mentioned a moment ago, set by the London Fix, an old pricing mechanism before the internet made real-time feeds a more reliable method of generating a spot price. And in 2011, the spot price of silver reached a high of $49.21. Now you might be wondering, adjusted for inflation, what's the actual price? The 1980 high put silver at $200 per ounce when adjusted for inflation. The 2011 high is closer to $70, and the current valuations are between $45 and $50 per ounce. Put simply, we have another 50% of potential gains to go on our way to catching up to the inflation-adjusted high of 2011. But historians know that the road to $50 silver has been rocky. In both 1980 and 2011, there were some tactics employed that drove silver prices down. The popularized version of the 1980 crash is that the Hunt brothers attempted to corner the market by buying up all available silver and creating a functional monopoly. The story is they miscalculated badly and overextended, missing a margin call that resulted in Silver Thursday and caused a near collapse of the financial system. And this is partly true, but it leaves out important details. The COMEX and Chicago Board of Trade had grown alarmed that the Hunts were indeed cornering the market successfully. In January of 1980, they colluded to impose new restrictions on their exchanges, the most salient being the introduction of liquidation-only trading. That meant traders could only sell or close open positions, not open new longs. They also raised margin requirements dramatically, and this was supposed to choke off the rally and stop the Hunts from buying more silver and force them to liquidate. This policy position is known as Silver Rule 7. The collapse on Silver Thursday appears orchestrated. The Hunts could no longer prop up the silver price, and the selling cascaded beyond what the exchanges expected, dragging brokers, banks, and even the Federal Reserve into the mess. The Hunts took the fall. Of course, this alternate history isn't well known, but History has a funny way of rhyming. In 2011, as silver approached its historical high, the exchanges once again opened an old playbook. In 2011, Forbes reported that COMEX, under the CME, raised silver margin requirements by 84% in 2 weeks. Examining the historical records from CME Group's notices sent to participating members in 2011 shows increases did occur across the board. This widely reported and well-documented event is much easier to confirm than the details of Silver Thursday, keeping in mind that over 40 years ago we didn't have the kinds of electronic records we do now. But enough remains to confirm that silver prices have been obstructed as it approached key levels in the past, and some would say it's been the death knell for the silver rally. But that's not going to work this time. First, it's true that margin requirements could be raised again, and in fact we'd be surprised if they weren't. And rules and policies can be adjusted in many subtle ways to affect the buying and selling behavior on exchanges, which is largely where the price setting occurs. However, the difference between 1980, 2011, and 2025 is that the markets are no longer centrally controlled. In 1980 and 2011, the COMEX had a near monopoly on silver futures pricing, so raising margin requirements directly drained liquidity and forced the longs to sell. Silver markets are now more fragmented, with exposure spread across ETFs, over-the-counter derivatives, a robust physical bullion market, and foreign exchanges like Shanghai, MCX, Zurich, and London. Let's say margin requirements are hiked in New York. It's possible, maybe even likely, but let's tease that out a bit. If silver pushes $50 again, CME raising margins could trigger selling in the West, but if Chinese demand stays strong, Shanghai could keep a floor under prices. In fact, we've already seen divergence at times. Shanghai prices have traded at a premium to COMEX when Chinese demand was intense. And in the past few weeks, we've seen rallies begin overnight while America was asleep. For example, silver had risen 2% between the evening of September 28th and the morning of September 29th, a Monday. Western traders are increasingly waking up to gap-ups in precious metal prices, indicating that the monopoly pricing power once enjoyed by the COMEX has eroded. Make no mistake, raising margin requirements would have an effect. But just as the Romans would mix water with wine to lower its intoxicating effects, the impact is likely to be diluted. Keep your eyes open for any changes in policies or rules meant to curtail the rally in precious metals we've witnessed to date. But also know, when it happens, it's not a curtain call. Both silver and gold have strong floors of support, and a rally to new all-time highs is in sight. Whether natural selling pressure occurs to thwart a historical milestone or interference from third parties happens, one thing is certain. We are living in strange and exciting times. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.